Hey everyone, and welcome back to Financial Fortitude, where we help you make smarter financial decisions so you can enjoy life now and still crush your long-term goals. Today, we're talking about something that's back in the spotlight, federal student loans.
And if you've got student loans or know someone who does, this episode is packed with important updates, such as online applications. They're live again at studentaid.gov. That means you can now submit your income-driven repayment plan or request a loan consolidation. We'll explain what that means and who should consider taking action. We'll also talk about tax strategies, especially with the SAVE plan facing a lawsuit. Your 2024 tax filing choice could impact your monthly student loan payment, so we'll break that down. And finally, we'll walk through what payments might look like if popular repayment plans like SAVE, Pay, or ICR are taken off the table.
Lots of changes, lots of moving pieces, but we're here to make it all easier to understand. Let's get into it. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerle. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in.
Alrighty, Michael, I'm very excited about this episode because I think outside of perhaps some market questions, student loan questions are what we're receiving most of, at least with a lot of the clientele that we work with. So I'd love for you to go into at least some basic detail on essentially what the heck has been going on with student loans for the past 2 to 3 months. I know it's a bit of a loaded question, but what the heck's been happening?
Yeah, there's a lot been happening, honestly, and there's been a lot of let's hold the line and wait and see, but then a lot of, oh no, I don't know what to do. You know, I'm being handcuffed right now. Not a whole lot of action can be done, even though I want to emotionally, or maybe I need to, right? And a lot of that stems from a couple of things. One, we know that from prior episodes that there is a lawsuit still pending with the Saving on a Valuable Education Plan, and that started back in spring of 2024. And there's still no resolution that's been found, okay? So that's been a huge headache for borrowers. At first, it was kind of cool, like, hey, you know, borrowers aren't required to make any payments because they're being pushed into a revolving general forbearance. So again, borrowers do not have to make payments while they're in that general forbearance. Interest is supposed to not be accruing for these borrowers who were previously enrolled into the Saving on a Valuable Education Plan. But the big imperfection with what's going on during this period of time is that time spent in this general forbearance does not provide credit towards public service loan forgiveness or time-based forgiveness. Now, not a huge ordeal for public service loan forgiveness because there is the buyback program where borrowers can, at the end of it all, once they've identified that, hey, I do have 120 eligible payments, they're just not all qualifying, that they have an opportunity as a borrower to lump sum buy back months that did not get counted during any sort of qualifying forbearance period. This would be one of those options or one of those periods of time.
So tell me more, if it doesn't hurt as much public student loan forgiveness, well, who does it hurt or why does it hurt more so time-based forgiveness?
Well, it's going to hurt time-based forgiveness borrowers more, or individuals who are on that track of making an income-driven repayment for 20 or 25 years. Primarily because they don't have a buyback option for these general forbearance timeframes. So right now, these non-payments really don't hurt their situation. They're just not being counted towards the 20 years or 25 years worth of payments that are required for their loans to be forgiven.
Sure. So explain for many of our clients who might be in time-based, may not be eligible for PSLF. What is that buyback option? How does it truly benefit the borrower in the event that they actually consider using the buyback?
Yeah, so for a borrower who's working for a qualifying public service loan forgiveness employer, again, during this period of time since last spring, none of these months of non-payments, quote unquote, really count towards their total qualifying payment need of 120 months, right? 10 years, basically. Mm-hmm. So fast forward, let's walk through an example. Let's say that a physician or someone who's eligible based on their employer for public service loan forgiveness has counted that there's, let's just say 112 months of qualifying payments out of the 120 that they need. And the new widget at studentaid.gov, which is really neat, that counts how many qualifying versus eligible payments a borrower has for PSLF, denotes that, hey, you have 10 eligible payments that have not been certified yet. Well, they haven't been certified because one, payments haven't been made during this period of time, but also because the education department really hasn't been processing a lot of actions at this point, right? PSLF employment certification, income-driven repayment applications, or even consolidation request applications. So what the borrower can do is submit a public service loan forgiveness form requesting that, hey, I believe I have 120 qualifying payments and that I'm eligible for forgiveness. The education department is supposed to review that and confirm or deny whether or not that they've satisfied the 120 months. Well, if they only have 112 qualifying payments out of the 120, they're going to get a declination. They're going to be declined. But what that declination offers is it triggers the opportunity for the borrower to then buy back the 8 remaining months that are eligible. They just haven't been qualified yet. So again, this is an opportunity for these borrowers to make a lump sum payment for those 8 months, get 120 qualifying payments under their belt, and then what is supposed to happen after that is their loans are supposed to be given tax-free.
Okay, great. So it just gives the public loan or PSLF candidates a little bit more wiggle room as to when they actually decide to advance the forgiveness of the loan. Whereas the time-based individuals, it's, hey, we're kind of just stuck in this limbo for an unknown period of time. What was supposed to be just a few months has now turned into much longer.
Yeah, and I would say that's the conundrum of it all, or the stressful piece of it all for borrowers, is that they really don't have any sort of finish line at the end of the tunnel as to when this save plan lawsuit is going to be resolved. Now, one thing that we have recognized is that, hey, income-based repayment is actually a viable option for borrowers to shift into if they want to submit a new income-driven repayment application. But there is a catch to that because on February 18th of 2025, a federal court issued a new injunction preventing the U.S. Department of Education from implementing the Saving on a Valuable Education Plan and parts of other income-driven repayment applications or plans themselves. So even if we wanted to, for the past month and a half, to go in and change our current income-driven repayment plan as a borrower, we really haven't been allowed. So much so that the education department was forced to take down the online widget or tool for borrowers to go in and submit a new application for a new income-driven repayment plan, as well as for, borrowers that were wanting to request to consolidate their loans. So it's created a lot of anxiety and stress. And we recognize as practitioners that, when it comes to student loan planning as a whole, one of the biggest value adds is being able to have a timeline, or at least seeing the light at the end of the tunnel, as opposed to just working towards something into an abyss where there's no real end point or end date in mind. And I think that's what's creating this unnecessary anxiety.
Sure. So given what's transpired over the last couple of months, where do we stand today, or at least from what we know now, what does the landscape look like moving into now Q2?
Yeah, well, surprise, surprise, because this is such a fluid environment and situation. We've seen nothing like this up until this point, right? I mean, from the pandemic, things became very fluid, but even still, it was still pretty consistent for, 12 to 18 to 24 months. And then you would see new legislative changes come into the student loan realm. But over the course of the last, we'll call it 12 months, it's been very volatile or fluid within the student loan environment. But as of March 26, 2025, and this is coming from studentaid.gov, they state that the online income-driven repayment application is once again available for eligible borrowers to apply for the income-based repayment IBR, pay-as-you-earn, PAYE, and income contingent repayment ICR plans, which is great news, right? The online loan consolidation application is also available again. Although the IDR application, IDR stands for income-driven repayment, is now available, loan servicers are still updating their systems in accordance with the court's actions. Servicers will begin processing applications in the near future. Now, this is a great message, right? Because one, we as practitioners who are guiding our clients, or any federal borrower out there who understands how to navigate this environment themselves, can go and submit applications online now electronically, which is great because the paper applications are not a lot of fun, right? We've both experienced that for our clients, but they're a necessary evil when needed, which is what makes us valuable for our clients, is that we know how to fill those out in a timely fashion so that they can then mail those off. But the one piece of this message, albeit promising, is that there's no real timeline on when applications are going to be processed again. We have a handful of clients that submitted income-driven repayment applications to change from the save plan that they were in early on in 2024. And we were holding the line from spring of 2024 through about the end of the year, and then wanted to make the decision to transition to either pay as you earn or income-based repayment, just so that we can continue to have those payments counted either for time-based forgiveness or public service loan forgiveness. And their applications are still pending processing, and there's no real update. And if they call their loan servicer, whichever loan servicer it is, they're not really providing any guidance, no fault to them. The news trickles down to them. And there's been a whole lot of inconsistency between studentaid.gov or the education department and the 3 to 4 loan servicers that are out there. So there's been a lot of, miscommunication. One party is sending out one piece of information, and then the other parties are sending out different information, and they conflict with each other. So that's where we've been able to step in and assist. But again, for better or for worse, these applications are now available online. I'm sure they're going to be flooded with millions of borrowers trying to change plans. It's really just going to be a matter of, well, how quickly are they going to turn around and actually get these processed?
So let's actually dig into that a little bit. Is for those borrowers who have been in a more general forbearance, what would be the rush or the quick calls to action to want to change now that it's available online again? Why?
Yeah, so it's really twofold in my opinion. One, from an emotional or psychological or even behavioral standpoint, doing nothing and wanting to work towards time-based forgiveness or even public service loan forgiveness for that matter, and not seeing the qualifying numbers go up, knowing that you've been working in a qualifying environment is, I won't say traumatizing. I think that's too rigid of a word, but it does affect you
discouraging,
mentally, right?
Perhaps.
Yeah, discouraging is a better word, because you're sitting here working, especially as a resident, right, where you're overworked, underpaid, and in your mind, it's like, hey, these are supposed to be the glory years, albeit being underpaid and overworked, where I'm making the least amount of income. So I technically could have $0 payments for up to 24 months. If it's a 3 to 4 year residency, that's already 24 out of the 120 months that I need in order to have forgiveness, right? So that's where there's a lot of anxiety around, like, hey, are these residency years really going to work or count for me? Mm-hmm. Or is public service loan forgiveness really not a viable option anymore? Do I really need to start having the internal conversation and motivate myself to move forward with trying to pay these off in full once I get into my attending role or my attending position? So that's one reason. The other one is more of a concern of on the time-based forgiveness side of things. And it's just because borrowers don't want to be making payments towards their loans for 20 or 25 years and beyond if they don't have to.
Especially borrowers who are just stepping into their repayment years in their late 20s, early 30s. All of a sudden, what becomes a 20 or 25 year timeline is, hey, I might retire right around the same time my student loans are done. And that doesn't feel, I think, as to what people expect in their heads. Like, hey, it's time to get the show on the road because I don't want to be 60 or 65 still making payments.
Yeah, and I would say it's even more detrimental for those parents who took out loans for their children, or maybe even those professionals who have been dragging these loans out with no real game plan, no fault to them. And they're in their late 40s, early 50s, and in some instances, late 50s. And with some of the provisions that came out during 2023 for loan consolidations, which then improved the number of payments that would be counted towards time-based forgiveness for borrowers, that was put forth by the former administration, they're now in limbo. So they might have thought that they only needed another, 12 to 36 months worth of income-driven repayments before time-based forgiveness was granted. And now they're in this limbo because these months are not counting towards time-based forgiveness. And what made SAVE so appealing was how rich of a deduction against the borrower's adjusted gross income the U.S. poverty line offered. It's as much as $100, $150 difference in monthly payment in some instances. And we'll talk about some of the math here in a little bit. But yeah, those would be some of the biggest advantages or disadvantages as to why borrowers might want to consider, making changes to their income-driven repayment at this point versus just sitting back, not making payments, no interest accruing, but just recognizing, hey, these payments aren't counting towards anything at this point, or these non-payments aren't counting towards anything at this point.
So as you start to mention AGI, I know we're headed towards the tax conversation. So talk to us more about how this current debacle essentially affects borrowers during this upcoming tax season, knowing, of course, we are not CPAs as much as we can deliver.
Yeah, and before we get into the tax piece, I do want to disclose that, again, like Brady mentioned, we're not certified public accountants. We're not enrolled agents. We don't hold ourselves out as being tax specialists, right? We don't file taxes. anything that you might hear on this conversation, you should consider reviewing with your trusted tax professional and or CPA or accountant, whoever helps you file your taxes before making any adjustments. What we're doing is simply sharing some examples of what we have seen or what has worked in the past. But again, it's recommended that you reach out to a trusted tax specialist before making any adjustments. And so the reason why this is such a big, what I would call opportunity right now during this tax season for 2024 tax season is really how the student loan payments are calculated. Okay, so the way that student loan payments are calculated from an income-driven repayment standpoint is that they will look at the borrower's most recent tax filing, and they're going to use the adjusted gross income from their federal form 1040. Now, let's take someone who just recently completed medical school in the spring of 2024. They typically did not work or do not work while in medical school as a full-time student. So their AGI, or their adjusted gross income, is 0. Well, that tax filing, even if you have a 0 income, we encourage, these borrowers to go out and file their taxes even with 0 income, would then be used or leveraged when applying for an income-driven repayment plan so long as a new tax filing has not been submitted. Okay, so right now we're in the middle of tax season, Q1 of 2025, filing for 2024. So if a borrower goes ahead and files their taxes today, they can no longer use that 0 income from their 2023 tax filing. Now, why is that problematic? Well, with most income-driven repayment plans, because of how lucrative the U.S. poverty line deduction is, these borrowers would have a 0 per month dollar payment for 12 months. Okay, and those would count towards public service loan forgiveness as a qualifying payment. Now, this is problematic primarily because these past couple of months, we'll call it up to 12 months from when these medical students went into their first year of residency in summertime, we'll call it June or July of 2024, well, they haven't been able to make payments or even get enrolled in some income-driven repayment plans because of this SAVE plan lawsuit. So here we are thinking that they're going to get $0 payments from June, we'll call it June 2024 through June 2025, but in reality, that's not the case just because they haven't been able to make payments. So now if they turn around, file their taxes today, well, now they're going to be forced to use a partial year of income during their first half of their PGY1 or first year of residency year, which means that they missed out on those $0 payment months in theory. So it's a matter of, am I going to miss out on lower payments? In some instances, because borrowers haven't been required to recertify their income and leverage their tax filing documents for the past couple of years, if borrowers filed their taxes married jointly in 2023, well, now is an opportunity for them to turn around and file their taxes married filing separately if that's going to help them get a lower monthly student loan payment and they're cash flow positive when taking into account any increased tax liability from a tax filing perspective. So there's pros and cons to what's taking place right now.
What I'm hearing is for certain individuals, just depending on the timing of when you're filing taxes, the experience that we're seeing in the student loan world could have hurt you. Whereas for some borrowers, there's an opportunity to essentially latch onto or grab onto older, lower income to certify and keep your payments low for longer. Do I have that right or am I off base there?
That's 100% correct. And the other caveat that we need to add here, because again, nothing with student loans, federal student loans has been relatively clear, straightforward for some time now, is that some of the student loan servicers, one in particular, Mohila, has already announced that borrowers will not be required to recertify their income until the earliest of February 2026. And we've even had some clients who have received notices that they're not required to recertify their income from their other loan servicers until as late as December 2026.
Oh, wow.
So again, this is very situational for each borrower, depending on the makeup of their household, their income, what their student loan repayment strategy looks like, and really going in surgically to determine and calculate, okay, what is going to be the best viable option? Do we go ahead and file taxes and don't hold back just because of where you're at in this process? Or do we file for an extension where you basically go ahead and pay up your assumed amount of tax that's due up front for the prior tax year? You just don't file the taxes with the IRS as of yet. You have until October 15th to complete that tax filing. And again, what you're going to want to do in that situation is speak with your trusted tax planning professional or tax filing professional just to make sure that everything is conducted appropriately. Because what you don't want to do is run into any issues with the IRS.
So, Michael, with all that in mind, what would you say the tax filing status truly offers borrowers the opportunity for?
One of the things that's offered is the flexibility to leverage lower income years in, let's just say, 2023 tax year versus slightly higher income in 2024. Okay. And so for borrowers who want to file the extension, what they're really doing is just buying themselves more time to make a decision as to whether or not they should finalize their taxes married jointly or married filing separately. And in that scenario, again, you have until October 15th of 2025 to complete your tax filing for 2024. So the idea is that if you're bullish or very optimistic that you think there's going to be some resolution with this Save Plan lawsuit prior to October 1st, then a tax filing extension could make sense. If you're bearish on the matter, very pessimistic, then we might as well just go ahead and file the taxes before April 15, 2025 for the 2024 tax season and be done with it. But just understanding what is lost is potential lower payments. Now, with that being said, if the Save Plan is thrown out based on the lawsuit resolution, there are concerns that other income-driven repayment plans that are not protected by Congress, like income-based repayment, IBR, could be thrown out as well. Some of these other plans consist of pay-as-you-earn, payee, revised pay-as-you-earn, known as Repayee, which was essentially replaced by Save, and then, of course, Save. Now, this isn't a huge ordeal for a lot of borrowers just because new income-based repayment or old income-based repayment mimic the payee plan, pay-as-you-earn very similarly. So new income-based repayment is going to use 10% of the household discretionary income. Old income-based repayment is going to use 15%. So a little bit different there. But outside of that, relatively the same. So when we run calculations, it's not going to be a huge difference. But again, the income-based repayment plan is one plan of the income-driven plans that is protected by Congress. So let's go ahead and jump into one of these examples.
Okay.
So first example, let's say husband and wife. Wife is a resident. Okay. She just started residency in the summer of 2024, did not work during her fourth year of medical school, so had zero income or zero adjusted gross income on their tax filing in 2023. In 2024, had W-2 income of about $32,000. And again, that's a half year of earning income as a first year resident, PGY1, and will likely earn a total of about $75,000 in 2025 as they transition out of their first year of PGY1 and into their second year of residency known as PGY2. Okay, and so on and so forth. You can just see how the income starts to increase. Mm-hmm. And this is a 3-year residency program. So by the fourth year, they're in their attending position making full income, which is, let's call it $250,000 to $300,000 a year. So pretty substantial increase. Now, the husband, on the other hand, is non-medical and earns around $130,000 a year. No student loans. The resident has about $380,000 in federal student loans. So pretty sizable chunk.
Is this borrower eligible for public student loan forgiveness or time-based or perhaps both?
So this borrower is eligible for both. Now, the initial game plan is that this borrower is going to focus on public service loan forgiveness based on the residency program that they're in being eligible for PSLF. And then based on where they anticipate taking their career, they believe that their future employment opportunities will also qualify for public service loan forgiveness. So this is the mindset that we have at this point. And I can tell you that for this borrower, there has been a lot of anxiety around, well, is PSLF even really going to be a thing? Now, the good news is that, yes, there has been some fear mongering in the headlines. There have been blog posts and articles that have been stating that public service loan forgiveness is at risk. Public service loan forgiveness is another student loan item that is protected by Congress at this point. So it would be a huge overhaul for Congress to be able to flip that and take it away. Now, could there be changes made to what's considered a qualifying or eligible employer? There could, and that's just the volatility or the fluidity of the situation. Same thing with repayment options. Changes can always occur, whether it be through executive order or through Congress, but this is where proactive planning comes into play versus just setting and forgetting it with these student loan plans.
And I think a comment worth making there is just framing what you can and can't control, right? We
Correct.
can't control the payment plan that we're in, the information that we know. We can't control what Congress or anyone else from a government standpoint actually does. And that's
Correct.
The encouragement we're giving clients on many instances to say, let's focus on what we can control, and everything else we'll just work to plan around with good planning.
Correct. So what I want to do is run through some numbers as far as what their monthly payments would look like. Okay. So because the Save Plan application was never processed over the summer of 2024 using 2023's income, we have yet to be able to realize the $0 payments for this resident for the first half of their residency training, right, as far as year one goes. So what we're looking at doing is filing an extension until October 15th of 2025 so that if for whatever reason they start processing income-driven repayment plans relatively soon within the next couple months, we can resubmit an updated income-driven repayment plan to get into income-based repayment using the 2023 Tax Form 1040 from 2023 that shows zero income. Okay, and again, that's going to lock in 12 months worth of payments at most as $0 payment. Well, we then finalize the taxes before October 15th, come around to 2026. Now what we look to do is leverage 2024's W-2 income, which had, we'll call it adjusted gross income of about $32,000. Now, when I run the numbers, if the Save Plan remains intact and this household decides to file their taxes married separately, this borrower would have a second 12-month time frame of $0 payments because of how lucrative that U.S. poverty line deduction is. Again, it's inflated by 225% as far as the U.S. poverty line deduction goes. So as long as this borrower's income is below $33,885, as far as adjusted gross income goes, their payment would be zero or close to it. Now, if the borrower decides to file their taxes married jointly, again, the husband makes $130,000 a year, then their household adjusted gross income would be in the realm of about $162,000. Well, they would get a second U.S. poverty line deduction, which would take their deduction up to about $45,990. And based off of a 10% of household discretionary income calculation, this borrower's monthly payment would be about $967 per month. So if we look at this, we say, okay, I can file my taxes married separately and my payment's zero or close to. Or I can file married jointly and my monthly payment would be $967. Which route would you take?
I would say is the simple answer is zero payments, right? Why would I not take zero payments?
Right. No, exactly. And one thing that you can't overlook, though, is, okay, well, if I'm filing married separately, what are the tax liabilities that could increase on my taxes?
For my spouse, that is.
For my spouse or for myself, right? Well, for this situation, there's no real estate that's owned. There are no dependents. So there's really not a huge significant difference. But even if there were, on the course of a year, this household is saving in student loan payments roughly $11,604. So as long as their tax liability increase isn't more than $11,604, well, going this path makes the most sense, because with public service loan forgiveness, the name of the game is pay the least amount required and maximize the total amount that's forgiven tax-free.
Yep. For this client who is bullish that there will be changes made to Save Plan, it does make sense to work with a tax professional, file for an extension, wait and see ultimately what gets changed, knowing that they can still grab onto or leverage their lowest income years.
Yeah, absolutely. Now, we also need to be proactive in planning for, well, what if the Save Plan gets thrown out? What if income-based repayment is the only viable option? Well, we can prepare with those numbers as well. So let's use those exact same data points. So again, married filing separately, this borrower had W-2 income in 2024 of $32,000. Well, the U.S. poverty line deduction with new income-based repayments only inflated by 150% as opposed to 225%. So the U.S. poverty line deduction for a single individual is only $22,590 versus the $33,885. So when taking 10% of that household discretionary income, this borrower's monthly payment is going to be in the realm of about $78 a month. So a little bit higher than zero per month. Now, if they file married jointly, and again, the spouse was making $130,000 a year, so total household income of $162,000, the U.S. poverty line deduction for a family of two gets adjusted to $30,660 versus the $45,990. 10% of the household discretionary income brings the borrower's monthly payment to $1,094.50. Okay, so a pretty steep increase compared to the Save Plan married filing jointly at $966.75. The difference here for this borrower for married filing separately versus married filing jointly with income-based repayment is about $1,000 per month. So again, pretty sizable opportunity at hand for this borrower to be able to say, hey, what can I do with this extra cash flow that I've freed up? Knowing that the tax liability is probably not significant, but again, you need to confirm and check with your tax filing professional that you trust and work with.
So I guess with all of that in mind, or running some of the numbers, we can see leveraging almost tax planning with student loan planning side by side can make a big impact. What are you seeing as common themes or actions taken by most of the federal borrowers that cross your path, at least here and now? Like, what are sentiments, insights, perhaps that are not coming from the headlines, that are just looking to grab your attention by any means necessary?
We've seen all of it, right? We've seen those who are very optimistic on the matter and saying, hey, I'm not making any payments to the federal education department, so that's money in my pocket. I'm just going to keep squirreling it away so that if payments do ever restart, I'll just make a lump sum payment. Or, hey, I'm using these non-payments opportunities to then take these quote unquote estimated monthly payments and pay down other high consumer debts, right? High interest rate consumer debts, or just building up my liquidity, right? Or I'm investing in other areas, or saving up and squirreling away funds for a down payment on a home. For those who are a little bit more anxious on the matter, a little bit more stressed, we're being behavioral coaches with them, talking through the situation and just, again, trying to reiterate, focus on what you can control. Unfortunately, we can't control what's going on in this situation, but if changes do need to be made, we can submit an application and we walk through them, or we walk with them through that process, either electronically and formally. Up until, last week, March 26th, we were completing these applications, on PDF, paper, mailing them off certified mail to see if they would get processed. What I emphasize for them is that, hey, we don't know when these are going to be processed. So we can take action in submitting them. We just don't know if they're going to be processed. Now, again, because we don't know when they're going to be processed, that's just kind of the nature of the beast at this point. But what I like to paint for these clients is I like to refer back to the plan at hand that we had designed before all this mess. And so going back to that example of the husband and wife, the wife is a medical professional and the husband isn't. If things go according to plan, and let's just say the SAVE plan is resurrected and borrowers have the opportunity to utilize it, what we calculated is that for this borrower, over the course of 120 months, they would only pay about $82,000 towards their student loans. Now, keep in mind, if they were to pay their loans back in 10 years, they would end up paying about $452,000. So talk about a massive opportunity cost, right? And again, this borrower is starting out with $380,000. Now, with that being said, about $380,000 in federal student loans would be forgiven tax-free through public service loan forgiveness based on current IRS tax rules with respect to PSLF. Okay, and the reason why it's $380,000 and no interest is accrued is because of one of the big components of the SAVE plan that's triggered this lawsuit, which is that unpaid interest does not accrue within the SAVE plan. That's what made it very lucrative for borrowers, but a little bit of a headache for Capitol Hill. Now, if the SAVE plan's thrown out for this borrower and we're using new income-based repayment, they end up paying about $94,000 out of their total outstanding loan balance of $380,000, and they end up receiving about $508,000 forgiven tax-free via PSLF. For this scenario, there are no interest subsidies on the unpaid accrued interest, which means that unpaid interest will accrue over time, which is why the balance increases up to over $500,000. But again, in the grand scheme of things, we're talking about paying either $82,000 up to about $94,000 towards these loans over the course of 120 qualifying months, instead of paying as much as $452,000 over a 10-year period if this borrower were to pay them back. So what this offers is the opportunity to pay less, take advantage of IRS tax codes that are available based on working eligibility for federal loan borrowers, and the opportunity to jumpstart your wealth building. Right? Even if they're able to save a fraction of what we're able to save them based on how they file their taxes and how we restructure their student loan payments and the asset location with them taking advantage of pre-tax deductions, there's an opportunity to generate a pretty sizable amount of wealth over the course of 10 years, right?
And I think that's our North Star for all of the conversations that we're having, right? Despite all the confusion, despite all of the uncertainty, despite all of the headlines that we're seeing, the true North Star is there's a strategy at hand that exists, some of which has all the question marks around it, but the rest of which is still truly pay less, save more along the way, get a loan forgiven, right? And at the end of the day, that's the coaching for clients, is let's tune out a lot of the noise on a day-to-day basis and just focus, hey, what can we control and where's the true benefit? Because the benefit's huge.
Correct. And for any federal borrower that's listening in on this today, if you want to go and do a little bit more investigation yourself as to some of these changes that have come down the pipeline, you can go to studentaid.gov/announcements/IDR-court-actions to be able to look through some of these announcements yourselves, as well as just work through some of the FAQs, which are pretty helpful. But again, here at Genesis Wealth Planning, we're doing the most that we can to stay in the know and send out updates to all of our clients that are dealing with this student loan debacle, just because, again, we recognize that if we can alleviate the stress of the uncertainties for them by pulling it back into the financial plan that we've designed and then provide prudent recommendations along the way that are nimble and flexible based on new information coming into the ether, then we're doing right for our clients.
Well, that's a wrap for today's episode of Financial Fortitude. We hope this helped clear up some of the confusion around what's been happening with the federal student loan environment and gave you a few action steps to take before moving forward.
Yep. And as a quick recap, again, online applications for income-driven repayment and consolidations are back. So if you've been waiting to make a move, now's the time. But of course, check in with your trusted financial advisor and our tax planning professional before you make any adjustments. Be strategic with your tax filing. Don't just subscribe to the plain vanilla of, okay, I'm married, I'll do married filing jointly, or hey, I'm single. Well, you really only have one option. You're going to file single, right? So not a whole lot of creativity that can be done there. But understand that your 2024 return could directly impact your loan payments, especially with the Saving on a Valuable Education plan under legal fire. And of course, if the SAVE plan, pay as you earn, or income contingent repayment plans go away, we want you to be ready. So stay informed and stay flexible.
And if you found this episode helpful, share it with a friend, a coworker, or anyone who's navigating student loans. And don't forget to subscribe so you never miss a future update or episode. We're keeping our ears to the ground on all things student loan policy. And of course, if you have any specific questions, feel free to submit them at www.genesiswealthplanning.com/AMA.
Thanks for listening, and we'll catch you on the next episode of Financial Fortitude.
Thank you for joining us this week on the Financial Fortitude podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady Hemmerle are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerle's California Insurance License Number 4353077 7237198.5 expiration 427.